The US dollar has been king of the global economy for decades, but every empire faces a turning point. In 2026, many analysts believe the dollar could start to lose some strength. Is this the beginning of a real decline, or just another short-term adjustment? Let's look at what drives the dollar, why experts predict a slowdown, and what could still keep it strong. To understand where we're going, we need to look at how we got here. That made US assets, treasury bonds, stocks, and savings far more attractive to investors worldwide. As demand for US investments surged, so did the dollar. By late 2024, the US dollar index, DXY, had climbed above 105, close to its highest level since the early 2000s. That's the power of tight monetary policy, a strong dollar backed by high yields and global confidence. The US dollar has ruled the global economy for decades, but every empire faces a turning point. In 2026, many analysts believe the dollar could start to lose some of its strength. Is this the beginning of a real decline, or just another short-term adjustment? To understand what's coming, we have to look at the forces that built the dollar's dominance, why experts think it might soften, and what could still keep it on top. Over the past few years, the dollar has been extremely strong. Between 2021 and 2024, the Federal Reserve raised interest rates from nearly 0 to above 5%, one of the fastest tightening cycles in 40 years. Those higher rates made U.S. assets, stocks, bonds, and savings more attractive to global investors, pulling in massive amounts of foreign capital. By late 2024, the U.S. dollar index had climbed above 105, close to its highest level in 2 decades. That surge wasn't just luck. It was driven by high yields, a robust economy, and global trust in U.S. stability. Now the tide may be turning. Forecasts from MUFG Bank, TD Economics, and Goldman Sachs all point to a mild weakening of the dollar in 2026. The main reason is simple. Interest rates are expected to fall. As inflation cools near the Fed's 2% target, policymakers plan to lower rates through 2025 and 2026. When rates fall, returns on U.S. investments shrink, and global investors start looking elsewhere for better yields. If Europe or parts of Asia keep their rates higher for longer, capital flows could shift away from the U.S., taking some demand for dollars with them. That shift is already reflected in currency projections. MUFG expects the euro to strengthen to about 125. While TD Economics puts it closer to 1.20 by the end of 2026, the Japanese yen could rise to around 144 per dollar, and the Chinese yuan might edge up from 7.05 to 7.0. These aren't dramatic moves, but they signal a consistent direction, a softer dollar after several years of dominance. Behind the forecasts are a few key economic mechanics. When U.S. interest rates drop, treasury bonds yield less, making them less appealing to foreign investors. Less demand for treasuries means less demand for dollars, since those investors have to sell dollars to buy other currencies. The trade balance matters too. A strong dollar makes U.S. exports more expensive abroad and imports cheaper at home, widening the trade deficit. That imbalance sends more dollars overseas than it brings in, creating natural downward pressure. Add to that the slow but steady effort by countries like China, Russia, and Brazil to trade in their own currencies instead of the dollar, and you start to see how global diversification can chip away at U.S. currency strength over time. If the dollar does weaken, the effects will be mixed. For American consumers, foreign goods could get a little pricier. European cars, Asian electronics, and overseas vacations might all cost more. But for U.S. exporters, a weaker dollar is good news. It makes American products cheaper abroad and can help boost manufacturing and agricultural sales. Globally, commodities priced in dollars, like oil and gold, often rise in value when the dollar dips, because it takes more dollars to buy the same amount of goods. That can push energy and metal prices higher worldwide. Still, there's a strong case for the dollar holding its ground. Even with rate cuts, the U.S. economy remains larger, more dynamic, and more diversified than most of its competitors. The U.S. is energy independent, politically influential, and home to the deepest financial markets in the world. When uncertainty hits, whether it's a war, a financial crisis, or political turmoil, investors don't flee the dollar. They rush toward it. That safe haven status is what keeps the dollar strong even in turbulent times. According to the Bank for International Settlements, the dollar is involved in nearly 90% of all global currency trades. That kind of dominance doesn't vanish because of a few economic headwinds. So 2026 may become a balancing act. On one side, slower U.S. growth, falling rates, and global diversification could nudge the dollar down. On the other, strong global demand for safe assets, deep capital markets, and the dollar's central role in global trade will likely keep it afloat. Most analysts expect the dollar to decline by only 3 to 5% against major currencies, a healthy correction, not a collapse. In the end, the story of the dollar in 2026 is one of moderation. It's not the fall of an empire, but a natural cooling after years of exceptional strength. The dollar may lose a bit of altitude, but it isn't going anywhere. If you want to know where it's headed, watch three things: the Fed's rate decisions, global inflation trends, and trade dynamics. Together, they'll tell you whether the dollar's just catching its breath or gearing up for another run at the top. The economic mechanics behind a weaker US dollar. When we talk about the dollar rising or falling, it's easy to treat it like a scoreboard, up or down, strong or weak. But behind every move in the currency's value are powerful economic forces that shape how money flows across the world. Understanding those mechanics helps explain why analysts think the US dollar could ease lower in 2026 and what really drives those shifts. The first and most important force is interest rates. Every major currency competes for global investment, and investors follow returns. When US interest rates are high, holding dollars becomes attractive because US Treasury bonds and savings accounts pay more. That extra yield pulls money into the US, pushing the dollar's value up. But if the Federal Reserve cuts rates, as many expect through 2025 and 2026, that advantage shrinks. Lower yields make investors look abroad for better returns in places like Europe or emerging Asia. As they sell dollars to buy euros, yen, or other currencies, the dollar naturally weakens. Another major factor is the trade balance, which measures how much the US exports versus how much it imports. When Americans buy more foreign goods than the world buys from the US, dollars flow out of the country. Think about it. Every imported car, phone, or shipment of coffee means dollars leaving American hands and ending up overseas. If exports don't keep pace, those extra dollars in global markets put mild downward pressure on the currency's value. A strong dollar itself can worsen this imbalance by making U.S. products more expensive abroad, creating a cycle that reinforces the trend. Closely tied to trade is the current account balance, which includes income from investments and services. A deficit here means the U.S. is sending more money out than it's bringing in. The deficit has to be financed by foreign investors buying U.S. assets. When global confidence is high, those inflows keep the dollar steady. But if investors start finding better returns elsewhere or expect slower U.S. growth, those inflows can slow down and the dollar softens as a result. The supply and demand for U.S. assets also plays a huge role. The dollar is backed by faith in U.S. markets, stocks, real estate, and above all, government bonds. If global investors think those assets will perform well, they buy dollars to invest. If they see risk or lower profits ahead, they pull back. For example, if Europe's economy rebounds faster than America's in 2026, money might flow into the Eurozone instead, boosting the euro and weakening the dollar. These flows can shift billions in a matter of days, especially as large funds and central banks adjust their portfolios. Inflation is another key piece of the puzzle. Higher inflation at home erodes a currency's purchasing power. Even if prices in other countries rise too, the relative difference matters. If the US sees inflation fall faster than its trading partners, the dollar can stabilize. But if American inflation stays sticky while others cool off, it undermines confidence in the currency. That's one reason the Federal Reserve watches inflation so closely. Keeping it near the 2% target protects both domestic stability and global trust in the dollar. Then there's the psychology of markets, which can amplify even small shifts. Currency traders react not just to data, but to expectations, what they think central banks will do next. If investors believe the Fed will cut rates aggressively, they often act early, selling dollars before the decision happens. Those expectations can move exchange rates long before any real policy change. That's why markets sometimes weaken the dollar months ahead of official rate cuts. It's the anticipation that drives prices first. Finally, global diversification trends are slowly reshaping how countries hold their reserves. Some central banks are increasing holdings of gold, euros, and yuan. While that's still a gradual process, every small shift reduces demand for dollars at the margins. Even so, no other currency yet matches the dollar's scale, liquidity, or depth of financial markets, so the long-term effect remains moderate, more a soft adjustment than a structural collapse. Put all these mechanics together and the picture becomes clearer. A weaker dollar doesn't happen by accident. It's the result of falling interest rate differentials, widening trade gaps, shifting investment flows, and evolving market psychology. Each factor nudges the balance just enough to move global exchange rates. In 2026, those forces may align for a mild downward adjustment, nothing dramatic, just the natural easing that follows years of exceptional strength. Understanding these economic levers reminds us that currency values aren't random. They're the world's collective verdict on growth, risk, and opportunity. And when those verdicts change, so does the price of a dollar. Why the US dollar might stay strong in 2026. For decades, the US dollar has been the backbone of the global financial system. It's the currency that fuels international trade, anchors central bank reserves, and sets the tone for global markets. While many analysts predict the dollar could weaken in 2026, there's a strong case that it will continue to hold its ground, and possibly even strengthen again. Let's look at why the dollar's power might not fade as easily as some expect. The first and most obvious reason is economic scale. The United States still has the largest economy in the world, producing nearly a quarter of global GDP. Its markets are deep, diverse, and highly liquid, which means investors can move large amounts of money without fear of instability. Even when growth slows, the U.S. economy remains far more productive and innovative than most of its peers. Its technology sector, energy independence, and strong consumer demand give it a natural advantage that supports the dollar's value. In contrast, much of Europe faces aging populations, high debt, and slower growth, while Japan continues to battle deflationary pressure. That difference in long-term economic fundamentals gives the U.S. dollar staying power. Another major factor is trust. The dollar is not just a currency, it's a safe haven. When global markets turn uncertain, investors look for stability, and history shows that they almost always turn to U.S. assets. We saw it in 2008 during the financial crisis, again in 2020 during the pandemic, and even during recent geopolitical tensions. Each time, rather than collapsing, the dollar strengthened. That pattern isn't accidental. It's the result of investor confidence in America's legal system, financial transparency, and political institutions, flawed as they may be. For all the criticism Washington receives, there's still no other country that combines economic scale, strong governance, and open markets quite like the U.S. monetary policy also plays a key role. The Federal Reserve's decisions have global influence, and its ability to adjust interest rates quickly gives it a level of credibility that most central banks envy. Even if the Fed begins cutting rates in 2025 or 2026, those reductions are starting from a higher base than many other economies. In other words, U.S. rates could still remain higher than those in Europe or Japan, keeping the dollar attractive to investors seeking yield. On top of that, U.S. inflation has been easing steadily toward the Fed's 2% target, signaling that the economy is stabilizing without tipping into crisis. A soft landing, slower growth without a deep recession, would reinforce confidence in both U.S. assets and the dollar itself. Then there's the global demand for U.S. treasuries, which is hard to overstate. Central banks, sovereign wealth funds, and major institutions hold trillions of dollars worth of U.S. government bonds. These bonds are seen as the safest assets in the world, reliable, liquid, and backed by the full faith and credit of the U.S. government. Even countries that criticize U.S. policy, like China or Russia, continue to hold large amounts of treasuries, because there's simply no real alternative of comparable safety and scale. This built-in demand supports the dollar's strength by ensuring there's always global appetite for dollar-denominated assets. The dollar's dominance in global trade also gives it a structural advantage. Roughly 80% of international trade transactions are priced or settled in U.S. dollars, including critical commodities such as oil, gas, and metals. Even when two non-U.S. countries trade with each other, they often use dollars as the medium of exchange. Efforts to de-dollarize trade, whether through local currency deals between Russia and China or new regional payment systems, remain small in comparison. The dollar is deeply embedded in financial infrastructure, and replacing it would take decades of coordination, political will, and trust that most nations simply don't share. Another pillar of strength is America's energy position. Over the past decade, the U.S. has become one of the world's largest producers of oil and natural gas. That energy independence shields it from the kinds of shocks that can destabilize other currencies. When Europe faces energy shortages or Asia experiences price spikes, the U.S. remains relatively stable, and that stability supports the dollar. Moreover, because most global energy contracts are still priced in dollars, every barrel of oil traded worldwide reinforces the greenback's importance. We also can't ignore the innovation factor. The United States continues to lead in technology, finance, and advanced manufacturing. Silicon Valley, Wall Street, and major research universities keep attracting global capital and talent. American companies dominate the world's largest stock exchanges and often set global trends in artificial intelligence, biotech, and green energy. This constant flow of innovation draws international investors into the U.S. market, creating ongoing demand for dollars. Critics often point to America's high national debt as a threat to the dollar, and it's true that long-term debt sustainability is a challenge. But so far, markets have shown remarkable confidence in U.S. borrowing capacity. Investors know that the U.S. has both the resources and the political will to meet its obligations. In fact, during times of crisis, U.S. government bonds are often seen as the ultimate safe asset, no matter how large the debt figure looks on paper. That paradox, where even fiscal risk drives investors toward the dollar, underscores its unique position in the global system. Geopolitics also plays a part. The U.S. still has unmatched military reach and global influence. Its alliances, trade agreements, and security networks extend across every region. Whether it's NATO in Europe, defense ties in Asia, or energy cooperation in the Middle East, the United States remains at the center of global stability. That strategic influence underpins the dollar's credibility. Countries prefer to hold reserves and conduct trade in the currency of the dominant power because it provides predictability and access to global markets. Until another nation can match that level of influence, the dollar's position will remain secure. Finally, we should remember that the dollar's strength isn't just about economics, it's about confidence. Currency values are shaped by perception as much as by data. As long as investors believe the United States is the safest place to store wealth, the dollar will remain strong. And history shows that in times of uncertainty, belief alone can be enough to keep capital flowing toward the U.S. So while forecasts for 2026 suggest a slight softening of the dollar, the fundamentals behind its dominance are still intact. The combination of economic scale, investor trust, global trade dependence, and financial depth gives the dollar a resilience no other currency can currently match. It may fluctuate from year to year, but the broader foundation is solid. In the end, 2026 may bring small adjustments rather than major shifts. The dollar might dip briefly as interest rates fall, then stabilize as markets recognize there's still no viable alternative. It's not the fall of a financial empire, it's the continuation of one. The greenback's reign might look different in the decades ahead, but for now, its grip on global finance remains firm. So, when you hear predictions about the dollar's decline, take them with perspective. History has tested this currency many times, and it has always rebounded. The world may diversify, new economies may rise, but the dollar's combination of stability, liquidity, and trust is still unmatched. So, will the dollar weaken in 2026? Probably, but only a little. It's less about collapse and more about balance returning to global markets. The dollar may step down from its peak, but it's still sitting on the throne. If you follow markets, watch the Fed, inflation, and global trade shifts, they'll tell you how the story unfolds. And if you had to bet, the safest bet of all might still be the US dollar.